When downward spikes in gold and silver happen, some are quick to point to the mysterious fat finger. But why is there no speculation with upward momentum? This is what research firm CPM Group questioned in a note sent out this week. So we want to get one trader's thoughts on the matter. Vince Lanci, founder of Echo Bay Partners, joins us today. Vince, welcome back to the show.
Thanks for having me, Daniela.
So we had an article up earlier this week where CPM Group said that in recent weeks, there's been a fair bit of discussion in the gold and silver markets about downward spikes in the prices of these metals.
Yes.
Yet they say that similar upward spikes in prices, no one really talks about this.
Right.
Do you agree with this?
Well, the first statement that you'll hear a lot more carping about markets that are spoofed or have flash crashes lower than you will hear complaining about $9 moves higher on light volume. So yes, I agree. It's just not covered as much.
Well, let's look at that July 6th silver crash. We had you on when it happened.
Yes.
And they would explain it as a combination of program trading, stop loss order practices, and an influx of institutional money into these markets. They would say it's not a fat finger trade, as many believed it was.
Everything that you just said, that Jeffrey Christian said, I agree with. I think what needs to be done, if you'll permit me, is to go into that just one level further to explain what that means.
Go ahead, because I'm just bringing up that event because when it happened, I know you were really angered by it.
I think it's a hallmark or a marquee event that can be used to explain many things. First of all, let's start with the fat finger concept. That's a mainstream media press thing. They just want to make it like a person or anthropomorphize a situation. There's no person with a fat finger anymore. For the most part, there's no manipulation or intent to make the market go lower by someone leaning on a button. Those days are over. Manipulation does happen, and it did happen as we see in the court cases that are coming up now. But what's happening now is not a fat finger. That's just a nice headline. What the Christian Precious Metals Group referred to as, if I recall what you said correctly, it's a combination of algorithm trading, institutional money, and stop losses. That's 100% correct. The question is, why doesn't it? Begs two questions to me that I think a reasonable person would ask. Number one, why doesn't that happen higher? It does not happen as higher as much. Okay. Number two, knowing why it does or does not happen higher, is it manipulation? And those questions need to be answered. If you'd like me to, I would love to just get into that.
How do we know it doesn't happen on the higher side?
Okay, it does happen on the higher side. I think what people misunderstand with regards to algorithms are robots. Picture Arnold Schwarzenegger, the Terminator. He doesn't care. The algorithm, the typical predatory algorithm, operates during thinly traded markets, whether it be gold, silver, crude oil. It happens in every market during thinly traded hours. Now, in the silver and gold markets specifically, during those thinly traded hours, you'll get these algorithms operating and they gun or fish for stops. Now, the silver and gold market have the majority of their stops lower, not higher. And that's why the market goes lower. It's not, let's manipulate silver and gold to zero.
But Vince, let me ask you this. A lot of people would say, okay, fine, it's not this mystery fat finger, but is it a government? Is it a central bank? Is it a bank?
Okay. I can give you three examples of who it could be, or of people that operate, firms that operate in this business. First, take the bullion dealers and take them out of the picture. What they used to do at 5 miles an hour is now being done at 1,000,000 miles an hour by algorithms run by hedge funds and firms that actually admit to that. Citadel would be an organization that does high-frequency trading and uses algorithms. Two Sigma is an organization. I'm not blaming them, but this is their business model, and that is to have algorithms that test the market to see where the weakest wall is. They push on the wall higher. If there's no stops, then they push on the wall lower. So the answer is banks have proprietary trading desks that use algorithms that do this. Hedge funds do it, and probably bullion desks do it as well. But it's an algorithm that it's not bullish or bearish. It's just looking for the
So
stops.
is it fair game to you then, Vince?
This is where there's a problem. I'm going to come down firmly on the side of it is manipulation and it is unethical and should be stopped. And here's what I'm getting at. To use algorithms to fish for stops in and of itself, unless you can prove that a person's only goal with an algorithm is to manipulate a market to trigger other people's orders, that's outright manipulation. And that can be proved by testing the algorithm. But the real issue here is the market itself. And in that piece we did last week, the problem is very simple. The algorithms, especially in silver when that happened, what you had is algorithms finding stops below the market because the longs had stops closer, and a snowball effect happened. Multiple algorithms started racing each other and the market swooned lower. Here's the problem, and this is a macro serious market structure problem. The algorithms are now faster in some instances than the exchange itself's ability to freshen up where its bids are. And so these predatory instruments use favorable status given to them by the exchange, and ultimately they destroy the market pricing mechanism and the exchange itself. That's where we're headed.
All right.
It's manipulation.
We could talk about this for hours, Vince. Just one last point, though. Would you agree that these spikes up and down are not unique to the precious metals industry?
Absolutely not unique. They're more exaggerated, more exacerbated because the precious metals markets are more consolidated in fewer hands to play. I'll give you an example that would parallel this type of market. Heating oil and gasoline on exchanges, thinly traded markets. An observation, when silver had its swoon lower, flash crash, whatever you want to call it, that same algorithm, from my eyes, was testing crude oil lower too and failed in its attempt. So the deeper the market, the less likely the algorithm has success. Silver and gold just are very thin for specific periods of time, and that's where the opportunity is.
Vince Lanci, always great speaking with you. Thanks so much for joining us.
Hey, Daniela.
Yes.
Would you mind if I plug something?
Go ahead.
Okay.
30 seconds.
As you know, I contribute to Market Slant. Next week, we've been doing some work, myself and the other writers have been doing some research on blockchain and the benefits to it in precious metals on the physical side. And we're going to be doing a 3-part series next week on if the two technologies can merge properly and how that would look for physical buyers of gold and silver.
All right. We'll watch for that. Thank you so much, Vince Lanci.
Thank you, Daniela. Have a great weekend.
And thanks for watching this edition of Kitco's Gold Report. We'll be back tomorrow.